Welcome, everyone. This is episode 48 of the Brandon Adams podcast. I have with me Edward Chancellor. Edward is the author of Devil Take the Hindmost, a 400-year history of financial speculation that came out in 1999. He was also the author of Crunch Time for Credit, which came out in 2005. And most recently, he's the author of The Price of Time, The Real Story of Interest. Edward, thanks for coming on.
Pleased to be with you, Brandon.
So this book, The Price of Time, this is one of my favorite recent books. I have to say that I took quite a long time to read this book. I really cherished every page. This is quite rare for a history book. I thought that your judgment about what to include on every page and in every paragraph was important. So I found myself taking a lot of time thinking, why did he include this argument, this study? Why did he exclude these events, these studies? I thought it was a very, very important work. And I want to quote from the front cover. Jim Grant, who's been on this podcast before, he says, a masterpiece of history, analysis, and properly understated outrage. I just want to say that I differ from Jim Grant here because I'm not sure that it's understated outrage. I practically feel like there's a Rage Against the Machine soundtrack playing in the background, and I think you actually tip your hand a bit at the end when you quote Michelle Houellebecq. There's a darkness here. I would say that it's more than understated outrage by the end. Is that a reasonable interpretation?
Possibly. So the book is an investigation into the nature of interest, and it was inspired by the fact that we've been living through an era of extraordinarily low interest rates, the lowest interest rates in 5 millennia of history. And as I progressed with the book, I came to the conclusion, as I'm laying out the argument, that these ultra low interest rates were causing rather profound problems along a number of different dimensions that we'll probably discuss in the, later. And I think if you will, the outrage or frustration I felt that perhaps can be sort of read between the lines is that we have a policy making class, what you might call a clerisy, that engages in grand experiments across a number of different fields, but here we're talking about monetary experiments, without properly considering the unintended consequences of their actions. And when people have presented to them some of those unintended consequences, their reaction has always been dismissive and to ridicule the criticism, and they have continued to persist for a long time, going down what I believe was the wrong road. So yes, there is a bit of outrage. I don't, in a way, I would hope that someone could read the book and learn quite a lot from it, even frankly, if they didn't agree with some of the analysis. So it's not solely a polemic. I don't see it as a polemic. I see it as something that's trying to elucidate a rather complex subject.
So the first 80 or 90 pages are the deep history of interest. And then we quite quickly jump to the modern era. There are some very entertaining chapters in those first 80 pages. There's some overlap there with your previous book, Devil Takes the Hindmost. There's an excellent chapter on John Law. Could you give us some of your background on John Law? He seems to be like the first extremely modern character in financial history.
Well, let me give you the background on where there's an overlap and where there isn't an overlap with my previous work. When I wrote Devil Take the Hindmost, it was in the 1990s, and that was the time when behavioral finance was on the ascendant, and we tended to look at speculative manias through the prism of human error, systemic human error, and that's a tradition that goes back to Charles Mackay's Extraordinary Popular Delusions and the Madness of Crowds, which is the first account of the great speculative bubbles, written in the 1840s. Now, missing from that story, the sort of behavioral story, is the monetary story. And really, I didn't include anything of that in the earlier book, and nor actually did I write about John Law in the earlier book. Now, what's interesting about John Law is that he's a Scottish genius of late 17th, early 18th century character who starts out life as a gambler, a murderer. He tours. He's forced to flee England after being charged with murder and found guilty. He obviously a man of great charm because he works his way around Europe, through the courts of Europe, and at the same time accumulating a great gambling fortune. Ends up in France just before the death of Louis XIV in 1715. And while he's gambling away, he's also an economic visionary. And his vision is very close to the modern monetarist view, which is that an economy will thrive providing there is enough money in circulation. And what Law does is he goes to the ruler of France after the death of Louis XIV, the regent, and says, let me found a central bank, let me abolish gold, I will bring down the cost of interest, I will make debt affordable, and I will bring prosperity to France. And for a brief while, Law, who founded the central bank, abolished gold, replaced it with a paper currency, and increased the money supply, roughly doubling the money supply. Consequences of this was a brief period of extraordinary prosperity in France, accompanied by tremendous asset price inflation, both in land and in particular in the value of the company that Law also owned and controlled, called the Mississippi Company, which was an enormous endeavor incorporating a lot of France's trading companies, other aspects, and eventually it also took over the entire French national debt. And in a very short period of time, the Mississippi Company's share price increased 20-fold. So it's a sort of bit like, one can't really compare it to any other company because it was the sort of largest, most extensive business the world has ever seen. But in terms of market performance, it was a bit like a sort of SPAC of 2020 vintage going through the roof. And then Law's system began to collapse, and it started to collapse as speculators cashed out their profits, and as inflation worked its way into the system, and as France's currency started to fall relative to sterling. And that left Law in a difficult position. He had to choose between either carrying on printing money in order to keep the bubble afloat, but that risked higher inflation, or he could deflate and, if you will, sort of save the currency, but sacrifice the company and the share price and his own fortune. And I think really when I wrote this, what was comic is that Law's failure. It's the grandest economic experiment prior to the Russian Revolution. And Law's failure, one might have thought, was a cautionary tale. But modern central bankers and monetary economists are entranced to Law. And if you read accounts by sort of conventional economists, and central bankers on Law's system, as he called it, they will say this is the foundation of modern central banking. And one looks at it, you say, well, if that's the foundation of modern central banking, then we have trouble in store. And that's, I think, is sort of more or less where we are today. So just as Law's system of controlling, of pushing down interest rates, inflating asset prices, and expanding the money supply ended in failure, admittedly very quickly. So this recent experience we've had of ultra low interest rates, quantitative easing, accompanied by a host of asset price bubbles, what we call the everything bubble, now seems to have run its course.
Yes, one thing that was very entertaining about that chapter is, as you mentioned, the problems came when people tried to cash in their gains, and they did things like buy fancy horse carriages and buy vineyard estates and buy some nice Paris townhouses.
Brandon, what do they do nowadays? They buy themselves fancy yachts, high price contemporary art, and book themselves on tourist flights into outer space.
Exactly.
Nothing really changes. Yeah.
Exactly. One notion that I've always been very intrigued by is a notion by Robert Shiller, and he actually presented it in the same year your book came out, Devil Take the Hindmost. He wrote a book called Irrational Exuberance in 1999. And he floats this concept called the moral anchor of a bubble. And he uses the term moral in an interesting way. What he's referring to is the idea that for a bubble to continue, it has to be the case that the speculators involved do not seek to cash in their gains for real things, right? So Law's bubble, or any financial bubble, it can continue, but for it to continue, there has to be, in a sense, a moral agreement among the speculators not to cash in their paper gains for real things, because as soon as they do, they will realize that the claims on wealth are not what they seem to be.
Sure, and that's the bubble is at some level a pyramid scheme or a chain letter or a Ponzi scheme, call it what you will, and providing there are more entrants than exits from the game can continue. But that actually is not really what interests me any longer. What I'm interested in, as I say, is the monetary underpinnings of the bubble. And what you find, there are an enormous number of bubbles out there. When I worked for this investment firm, GMO, we actually crunched the numbers on sort of 10,000 years of data and identified hundreds of bubbles across different asset classes. And some bubbles are just esoteric bubbles, that sort of rise and fall in a way a bit like what you're describing, as sort of under the sort of Ponzi scheme type bubbles. But actually, the great bubbles appear to have a monetary dimension to them. And the one way of seeing this is that, and if you remember in the chapter on John Law, I cite his biographer, James Buchan. And Buchan writes that the speculators seek to compress all the future into the current day and to reap the future, the rewards of the future, before actually the future arrives. They're really, technically we say that they're operating with the wrong discount rate. And that, in other words, to lower discount rate. And that discount rate might, it obviously should also incorporate a risk factor that their view might be wrong. Now, so the question, why is the discount rate wrong? And I'm arguing the discount rate is wrong, of the speculators, to some extent, because the monetary conditions have lowered society's discount rate to an artificially low level, which then engenders speculation. And if that's the case, then you would expect that the great bubbles will come to an end, not, as Schiller says, when they run out of new entrants. That's in a way obvious, but because the monetary conditions, the underlying monetary conditions are changing. Now let's look, we have been living without doubt in the great period of bubbles in history. I mean, if you've been working for the last 25 years, you've been through, the dot-com bubble, late 1990s, sort of myriad real estate bubbles in the early 2000s around the world. And then, as I argue in my book, we've gone through the everything bubble, which, really is, we don't have time to elaborate the number of assets that have been inflated in the bubble, but, including, and let's not forget, China's property bubble, which in terms of size is probably bigger than any property bubble that has ever existed anywhere, size and valuation. But then this great bubble in stocks and various other assets. And why do these, why do these bubbles come to an end when monetary policy tightens? They say, look at the dot-com bubble. The Fed was raising rates in 99, 2000, and then the real US real estate bubble, that started to burst in really sort of late 2005, 2006, after the Fed started hiking, and that started leading to problems in the among the subprime debt that sort of metastasizes problems across the world's global financial system. And then, more recently, when the Feds tried to tighten in 2018, remember the stock market took a big dip, and we had a sort of blow up of volatility in I think it was February 2018, and then more recently this year, with the beginning of this year, U.S. stock market was at the highest valuation in history on most measures, except possibly for the last few months of the dot-com bubble, according to some measures such as the Schiller price earnings ratio, cyclically adjusted price earnings ratio. And what's happened this year is the central banks have brought their quantitative easing policies to an end, and they've only really started to raise interest rates from extraordinarily low levels, and they remain highly negative policy rates in real terms. And yet, this just slightest restriction from the monetary policymakers is enough to send these asset markets, these inflated asset markets, into a sort of downward spin. So I don't, I have to say, I think if we'd had these these accommodating monetary conditions in place for another year, you'd have found more people joining the party, and asset prices would have continued levitating. But difficult to prove that you've run out of players versus we can only conjecture.
Yes. So it's really a central banking story at the end of the day. I do want to try to pinpoint why exactly this book is so good, because really you're telling a story that others have attempted to tell, and you're telling it much, much better. So let's go over the part where you overlap with others who have told the story. You think that the move to free floating exchange rates and a fully dollar-centric, US-centric international order is important. You think that the sort of long bull market in bonds and stocks that started, say, in the Volcker era was important from 81 onward. You thought that the Greenspan era was important, and particularly there you highlight the idea that it was somewhat evident to Greenspan that the aggressive monetary policy was finding its way into asset prices fully and was not finding its way into goods and services prices, which became an ongoing theme. And Greenspan attempted to tackle that. He had his famous irrational exuberance speech in late 96, but then decided to put it fully on the back burner. And then you credit his rate cut after the LTCM blow up with sort of the last phase of the dot-com bull market, the most manic phase. And then you say that it was sort of loose policy in the aftermath of the dot-com that led to the housing bubble. So up to this point in the story, you're relatively consistent with a lot of other narratives that have been told. And where you really differ is in the post-financial crisis era. You think that we engaged in some hardcore monetary experimentation that was very much misguided, and then we kept sort of doubling down on this experimentation. Is this a fair read?
Yeah, I think so. I mean, look, writing, obviously, certain people were critical of Alan Greenspan during his long tenure at the Fed, and if you remember, they criticized what was called the Greenspan put, the idea that the Federal Reserve saw it its job to underwrite asset prices, and how the Fed puts appeared to coincide with a series of asset price bubbles, because if you know that your downside is cut off, you'd be quite rational to start paying more for stuff. So and Greenspan, he as you mentioned, he mused about irrational exuberance. There was a bit of a debate, about how monetary policy makers should respond to asset price bubbles, and it was do you want to lean? I think it's called lean into the wind or whatever. I can't remember the exact phrase, which is should the monetary policy makers curtail the bubble, or should they clear it up afterwards? And the conventional view of the monetary policy making establishment is, we can't identify bubbles. The costs of dealing with the bubble in advance is relatively high in terms of lost economic output. Therefore, it's much better to clear up the mess afterwards. And then you have to think, what does clearing up the mess afterwards entail? Well, actually, it entails even lower interest rates than beforehand. So if, according to my argument, and I'm not the only person in the world who's saying this, is that if monetary policy induces the asset price bubble. And the aftermath of the asset price bubble is that you need even stronger monetary policy. In other words, the hair of the dog. Then you're going to get a sequence of asset price bubbles, and you're going to drive interest rates ever lower. And frankly, I mean, if you look at Fed funds rate over the cycle, over various cycles, look, take the period, let's say 91 to 2000 as one cycle, and I'm saying off the top of my head that Fed funds rate was probably averaging around 4.5% over that cycle, something like that. Then you take the next cycle, first of all, from 2001 to 2000 and let's say 2007 or 8, I'd say the Fed funds rate is probably averaging about 2.5% over that cycle. And then let's take the period from 2008 through to current day, saying off the top of my head, I'm not going to be far wrong, Fed funds rate's probably sort of averaging about 50 basis points. So you can see it coming down very sharply. The other thing what you can also see, because I allude to in the book, and I'm sure you're aware that the Fed produces its own estimates of US household net worth, which is really the best measure, as far as I can see, of all the assets in an economy. And you see that household net worth in each of these cycles relative to GDP is moving to a higher and higher peak. So we're getting lower and lower interest rates, and in aggregate, larger and larger asset price bubbles. So the asset price bubble associated with the US real estate boom up to the global to the subprime crisis was actually on the Fed funds net household net wealth data was actually a bigger bubble than the dot-com bubble, and then the everything bubble on the same measure was bigger than the preceding real estate bubbles. So we've had this great sequence of bubbles, and they actually look, if you actually look at the data, I mean, obviously this one has only started to come down, but the others, what my old boss Jeremy Grantham at GMO would say, he calls them well-formed bubbles. In other words, they rise and form more or less symmetrically, and they're clearly identifiable as bubbles, sort of from and you can measure them as bubbles, as we would have done at GMO, as measure them in terms of standard deviations from the mean of their real trend. I mean, which is a reasonable way of measuring a bubble.
So you approvingly cite Jim Grant that the Fed is both arsonist and firefighter. And it's not coincidental that the bubbles have gotten bigger and bigger, because part of the policy is to, when you're in a period of weakness, have improvements in asset prices sort of drive consumer demand. So to some extent, the
I mean, the technical term is God, I can't remember one could talk about the wealth effect, but they talked about portfolio. I think it was the portfolio balance channel was actually about driving up asset prices, but the Fed saw it as part of their duty to, if you will, sort of manipulate spending by driving up the valuation of assets. But as I argue in the books, one of the consequences of driving up the valuation of assets is you make some people inordinately richer, i.e. those who have assets and those who are older, and you make life a lot more difficult for those who don't have assets. In other words, the poor and the young. And then go back to this question, as you mentioned, sort of outrage. I think it is outrageous that central bankers have really had such a strong impact on the distribution of income and wealth in our economy. And it's outrageous that they have refuse to take that on board, and that their standard position is either to deny the data, which I lay out in the book, I think, quite carefully, or they say it is the job of policymakers, of politicians, to deal with distributional issues. But interest is always a question of distribution. and it's one of the things that, as you remember I write about, it's a fact of life that the less wealthy you are, the more of your wealth is kept in cash, because you need sort of rainy day savings to meet unexpected contingencies. But the richer you are, the more you can, if you will, lever up, and the less percentage of your wealth is in cash. So the poor suffered over the last decade from actually higher borrowing costs from banks and from and no reduction in credit card lending, but they got no interest on their cash deposits, on most of their household wealth, whereas richer people tended to do very well from this sustained period of asset price inflation.
Now, from a reading of your book, I wouldn't try to guess your politics, but it's fair to say that you have a deep trust in economics, in economic forces. You believe that an economy is a complex, adaptive system, not to be interfered with lightly. You, throughout the book, mention Hayek and Schumpeter. It's interesting. Hayek is still accorded a lot of respect, but sort of quickly paints you on the right side of the political spectrum. And Schumpeter has been sort of soft canceled by the economics profession. I appreciate that you're reviving him, because I've always been a fan.
Actually, tell me how he's, because I was unaware of that.
Oh, why Schumpeter had been soft canceled?
Yeah.
It does actually have to do with his sort of social and political views, if you will. Also, he was, he wasn't like the gentlemanly figure of Hayek, who's just sort of pronouncing things in speeches and books. He was a loud character, and that contributed, I think, to him being sort of soft canceled. But what I see, Schumpeter's notion of the entrepreneur as a key figure in the capitalist process is sort of lauded, as far as I know, in Silicon Valley. And Schumpeter's idea of creative destruction is also, you often hear it mentioned as we get a new wave of technologies, and Google or Amazon knock out X number of traditional businesses, and so I think that what I would say is that Schumpeter is probably selectively endorsed. I think with Hayek, he didn't, his view, as you say, is of the economy being a sort of a very complex information system in which no individual is capable of comprehending, of gathering the information necessary to make a correct decision. And the way then that the correct decision, or the optimal decision, is arrived by is to allow the market, which is an information exchange, to operate and determine and to set
prices. Now that is not an idea that is going to be grasped by those who want to, who really want to, whose natural bent is to interfere with this complex system. But wait one second. So at the end of my book, I cite, one of the people, contemporaries I lean on is Bill White, the former chief economist of the Bank for International Settlements.
Yeah, and early on, you cite his work, Ultra Easy Monetary Policy and the Law of Unintended Consequences from 2012.
Yes, and Brandon, that was I was thinking along the same lines when that paper came out. And I was writing a column in the FT at the time, and I wrote up that column. And I was at, as I say, I was at GMO, the investment firm in Boston, working the asset allocation team. And I started doing, at the time, doing an internal project on interest rates and so forth. So that was sort of the time of genesis. Anyhow, I end the book, this book, on citing Hayek's Nobel Prize winning speech, which is marvelously called The Pretense of Knowledge. So imagine, you have been given the grandest economic prize there is, and all you do is say, I'm operating in a profession that pretends to knowledge. And Hayek writes here, the recognition of the insuperable limits to knowledge ought indeed to teach the student of society a lesson of humility, which should guard him against becoming an accomplice in man's fatal striving to control society, a striving which makes him not only a tyrant over his fellows, but which may well make him the destroyer of a civilization which no brain has designed, but which has grown from the free efforts of millions of individuals. And in a footnote to that comment, I cite what Bill White, formerly of the BIS, wrote to me in an email. He says, central bankers make a profound epistemological error by failing to treat the economy as a complex adaptive system. All their other errors are derivative. Isn't that quite nice?
That's great.
Either you get that, and in a way, this book is in complete agreement with Bill White's position, or you don't get it. Either you see that we've got a complex adaptive system that we can't, as individuals, wholly grasp, or you see a system that is sort of naturally some or other in a sort of position of equilibrium and stasis, that you can tweak the levers and that you can't really do very much harm, and the harm, if you're doing anything at all, will show through some epiphenomenon such as, through the narrow epiphenomenon of either a rising or a falling consumer price index, and anything else that happens is of no concern to you. It's for me, I'm now thinking that it's almost as if there are two types of human beings: those who are hardwired to comprehend the notion of complexity, and those who cannot see it. And it's almost as if we live on parallel universes.
Yeah, when I say that Schumpeter has been sort of soft canceled, I guess what I mean is that I think that the names Hayek or Schumpeter have, with 100% probability, not been mentioned in the Eccles building in the last couple of years. So both are deeply unfashionable. And
yeah, but can I, so you mentioned, in 2005, I wrote what was actually a specialist report rather than a trade book on the credit boom that was going on in Britain and the US and elsewhere. But my main focus on US and Britain. And in that report or book, I do have a bit about Hayek, but I also have actually quite a lot about Hyman Minsky. Now, I became quite entranced with Hyman Minsky at the time, and wrote a long, not only wrote about in the report, but I wrote a long essay on Minsky that was published in early 2007, which was called Ponzi Nation. And as you know, Minsky was completely ignored by the economics profession. And incidentally, Minsky, as you may know, was a student of Schumpeter at Harvard's. And Minsky wasn't even given a place at an Ivy League college. He had to go off and work at the university. Is it called the University of George Washington in St. Louis? I mean, a perfectly good university, but not not your not your Ivy League college. And I remember asking an old Wall Street economist at the time, why did no one talk about Minsky? And he said, oh, he's difficult to model. And then as I was reading, one of the things I was reading about when I was reading, I read quite a lot of Minsky, and he's actually a difficult guy to read. He doesn't write like Adam Smith, let's say. And at one stage, and here's outrage, Minsky says, there's a little cry from Minsky, no one up there understands economics. And then I wrote this piece, I say, in early 2007. Over the course of the next 2 years, all hell breaks loose. And who suddenly comes back into fashion but Hyman Minsky? Hyman Minsky's on, he's suddenly on Ben Bernanke's lips, even. The man who was difficult to fashion, the man who said that if you will, that the balance sheets of the financial system were the all-important factor, the man who had a completely financial view of the capitalist system, and of the importance that the balance, that people could not only that the balance sheet balanced, but also that people could meet their debt service payments and so on and so forth. And suddenly, so we live in a world in which people ignore, in a way, the relevant economists or relevant way of thinking until it's too late, and suddenly they then come back into fashion. And everyone talked about the Lehman bust being a Minsky moment. Do you remember that term? The
Yes,
Minsky
of course.
moment. But when I wrote about Minsky in 2007, I could hardly find anyone, right? Paul McCulley at PIMCO had written a bit about him. I even actually had to cite people who I told Minsky about, like Jim Grant and my old boss, Jeremy Grantham, in order to be able to have someone to say, well, actually, some people are interested in Minsky. But there was almost no interest in Minsky then. And there is, now Hayek, the modern policy consensus is if you, they call it neo-Keynesian, but it's a largely Keynesian model with a bit of monetarism thrown in. And, as you probably know, Keynes and Hayek were there was a great big bust up in the 1930s, and really in terms of dominating the academic institutions, the Keynesians completely won that battle, and it became and people are not particularly aware of Hayek stuff. I remember. And perhaps I'm being indiscreet, but after the global financial crisis, we had Ken Rogoff of Harvard talking at the GMO client conference, and I took him out to lunch afterwards, and I said, what do you think of the sort of Austrian stuff, the Hayek? He said, I haven't really read any of that stuff. And I said to him, the Harvard economists must be, it must be a very interesting time for you all getting together and discussing what's happening. He said, oh, no, we don't really speak to each other. We all have our own different specialities. So, what can one say? Modern academic economics is highly specialized, has no interest in the history of economic thought, and doesn't comprehend the complex system, evolutionary system that Schumpeter wrote about.
Yeah, Minsky was hard to digest for the economics profession. There was one fellow Brit that was writing about him early, Peter Warburton.
Peter's a friend of mine. Yeah,
yeah. His book Debt and Delusion was quite a great book, and early on, I believe in Debt and Delusion, there's some extended pieces of about stabilizing an unstable economy by Minsky. But Minsky was tough because the Minsky framework is one where there's a complicated response function between participants and policymakers. And that is hard to digest, the fact that the participants are constantly sort of strategizing against the policymakers.
But yeah, let's stop there, because I think this is a very important point. That Minsky argues that that after a crisis, the policymakers come in to try to avoid a debt deflation by loosening monetary policy. And at the same time, they write regulations, financial regulations, in order to prevent a repetition of the past crisis. And then Minsky says, and tell me if you're thinking differently about it, this way I see it. Minsky then says, financial markets are full of very smart people, and they will find their way around the thicket of regulations and will do new stuff that's not really encompassed in the regulations, and that will set the scene for the next crisis. And that I think is very, that analysis is sort of embedded into this new book. When I discuss how when at a time when interest rates are very low, there's an encouragement to take all sorts of undue risks, whether leveraging up, or whether you have a deterioration in credit quality, or whether you're taking liquidity risk, or often taking all those risks together, leverage, credit, and liquidity. And there is this idea, which I don't think is correct, that monetary policy should do one thing, which is just focus on the price level, and regulation should put out all these fires, potential fires in the that are happening through, if you will, sort of irresponsible financial behavior. But there are never going to be enough regulators, and the regulators, frankly, to be blunt, are not going to be as smart or as well incentivized. But most of all, they won't have the right knowledge. They won't have the comprehensive knowledge to win that game. And so what we've seen in the last recent years is an extraordinary expansion of the length and breadth of financial regulation, and a massive increase in the number of compliance and regulatory personnel, bureaucracy, and yet it doesn't seem to prevent what we call regulatory arbitrage, of people finding their way around the regulations. It's a bit one. I don't think I mentioned it in the book, but one way I've always thought of this is, after the First World War, that the French built what's called the Maginot Line, which is sort of a great fortification on the German border, with masses of large guns, artillery, sort of on a range of hills and bunkers and so on. The idea was, the Germans would never be able to come into France as they had done in the First World War. What did the Germans do? They just went around the side. and there is, and one person on the sort of, on the sort of establishment side who I think clearly understands this. Well, two people. One is, as I mentioned, Claudio Borro at the Bank for International Settlements, and he's written a lot about this, and his papers definitely all worth reading. But also Jeremy Stein, who's a very smart economist at Harvard, and Stein was briefly a governor of the Federal Reserve after the global financial crisis, and he observed that with interest rates very low, that we were having all the sort of risk-taking activity that we'd seen prior to the financial crisis. And he in particular cited the deterioration of lending standards, whether measured by leverage in among buyouts and number of leveraged loans that were being issued, and the deterioration in credit quality as measured by the so-called payment in kind bonds. And what you see in Stein's charts is a massive increase of risk on these measures before the financial crisis, coming down very sharply and bouncing back afterwards. And Stein just makes this very succinct and very insightful comment, where he says, regulation is all very well, but only monetary policy, quote, gets into all the cracks. And really, if you think about, one of the what I'm trying to express in this book is how interest, whether people know it or not, sort of gets into all the cracks of the economic and financial system.
Yeah, it's a shame that Jeremy Stein hasn't written a book about his experience, because he was a quiet objector. I took a course with him back in grad school, and he is very polite, and he would never really go out on a limb with criticism. So what he wrote and spoke about was kind of harsh criticism of Fed policy in his language, right? In his polite.
Yeah, and bear in mind, he only took one term as a Fed governor, and then skedaddled back to Harvard, because I think he probably found it not a conducive environment. I think it was he told me that I think it was him who told me that, at least someone told me that during the Greenspan era, you weren't to mention the ill consequences or the prevalence of asset price bubbles. I think during the Bernanke era, you sort of weren't really meant to talk about interest. You weren't to make any connection between the easy money period preceding the financial crisis and the following, subprime bust and global financial crisis. So you can see that. I mean, if this is correct, you can see that the Federal Reserve is where the establishment with its hundreds of economists employing. Am I right in saying it employs up to half of the? It sounds almost too many, but I think I read that they employ half the finance, the monetary PhDs in the world, or whatever. Perhaps not that high, but you can see that the danger of that type of institution is it becomes a sort of echo chamber or a hive, dominated by its queen bee, and you don't want to express views that the queen bee doesn't care for. So I would look. Stein will have his own reasons, but I think he's the economy. For me, he's an economist who understands the sort of interactivity between finance and the economy. He doesn't, as you're aware, and as I write about, the trouble with, the sort of canonical models is that money is just a veil that doesn't really, that has no, and that has no effect on the underlying, real economy. I think that position is not correct.
I would agree. Yeah, the Fed, it has 800 staff economists, so it's probably true that they have half of the monetary economists that graduate. And there is
Can I just say, so one of the things was, I think I mentioned that Wall Street Journal had a sort of survey of economists after the global financial crisis, which they asked, did they think the Fed was responsible? And there was quite a large percentage, I think a majority of economists, academic thought the Fed, had played some role leading up to the global financial crisis, but the monetary economists didn't. It's as if, I don't know. Again, probably to do with looking at the world with different spectacles.
well, they knew who was paying their salary,
Yeah.
I suppose. And there's also strong evidence that um, when someone goes into the Fed, no matter what their views beforehand, they are quickly shaped by the institution. And part of it is that there's so much intellectual firepower there among those 800 staff economists that whatever the person's view, they're inclined to yield intellectually. So you take Jerome Powell as someone who probably had free market views. There was in the history an inclination to yield, right? But it was remarkable to watch his transition most acutely in the period that you mentioned, where he does the famous Powell pivot from the sort of late 2018 tightening to the early 2000s.
Yeah. But by the way, I mean, isn't Alan Greenspan an even better example where, in his youth, sits at the feet of Ayn Rand as part of her, I think it was called The Collective, and he writes, I mean, slightly cracked papers of how, I mean, I don't necessarily disagree with the analysis, but they're slightly cracked papers about, Fed and the gold standard and the 1920s boom and bust, and the inference being that the Fed caused great deal of these problems, and there you take this sort of purist of libertarian economist, as he purported to be at least, and then you put him in the Fed, and he then becomes, he really takes the Federal Reserve down a route, as we've discussed earlier with the Fed, the Fed put and constant intervention. So the Fed becomes more activist, and in the end, as you know, in my final chapter, I sort of say we really sort of moved into an age of central banker capitalism. Do you remember that Minsky has this sort of view that we live in different eras of capitalism, and where one player or one type of institution is dominant, and clearly in the last 13 years or so, and I would argue probably the last 25 years, what the Fed was doing is what everyone wanted to know, because they were the most important player.
Talking about this move to central banking capitalism and keeping in mind our time limit of around 10 more minutes, I wanted to sort of go to the last couple of chapters and look at March 2020. As you noted, Minsky believes that stability breeds instability, and there were good examples in late 2019 and early 2020. You had in early September of 2019, the repo crisis, which would have caused a great market disruption if the Fed hadn't acted very quickly. And then you had a quite incredible run up in the S&P and the NASDAQ at the end of 2019, going into early 2020. And then when COVID was really flaring up in Europe and the United States in early March, you had a quite insane level of disruption in the markets, in the equity markets and in the bond markets. And there was a rush
Yeah,
to cash that probably wasn't going to see an end. It was a terrifying week there. And then it led to a entirely new chapter in Fed intervention.
yeah. I mean, it's in a way we're sort of, it's a disaster, but we're sort of privileged to have lived through it. As I say, it makes all these other great periods of extraordinary popular delusions of the madness of crowd seem quite sort of rational and of almost no note. But just, I mean, think of, we had the March 2000, we had a very rapid collapse in the stock market, and very rapid widening of credit spreads, and you had you had a whole load of the sort of ETF complex, which was trading out of line with its net asset values, and I argue that the severity of that downturn was not the market reading accurately, or even attempting to read accurately, what the likely consequences of the pandemic were on cash flows and so forth, but really what I call the pre-existing condition, and the pre-existing condition being a long period of risk taking, leverage, and inflated asset prices. What I don't mention, so I have a former colleague who called Jamie Lee, who now works with Jeremy Grantham at his foundation. And Jamie's argument is that the stock market crash is what induced the policymakers to go into lockdown, because Jamie thinks that the market crash made the policymakers think, hey, this COVID thing really is serious. Look at what's happening on Wall Street. But if this analysis that actually the crash was sort of, if you will, backward looking and to do with fragility of the financial system, it wouldn't have taken really more than a puff of wind to bring that down. And then, as you say, after that, the central bankers go into overdrive. They become complacent after a decade of printing money, of quantitative easing, of bringing interest rates down. They have got used to the idea that inflation is under control. They credit themselves with controlling inflation. They remain obsessed with the idea that deflation is the great risk out there. And as I argue in the book, they massively overstate the deflation risk and don't really understand the nature of deflation, or at least they don't understand the difference between good and bad deflation. And they print, I think in aggregate, the major central banks print $8 trillion worth of fresh money. Governments run deficits of roughly the same order, and we get the last hurrah of the everything bubble. I think Charlie Munger says, Warren Buffett's sidekick says, this is the most extraordinary period in the entire history of finance. And I say, Munger, smart guy, he's not exaggerating. And you have the SPACs, you have the cryptocurrencies that sort of, you have spoof cryptocurrencies and you have spoof cryptocurrencies. You have these non-fungible tokens flying around the place of people purportedly paying millions of dollars for sort of, in effect, nothing, an image that that may or may not, a digital image that may or may not be replicated. and an air of complete unreality in the financial world, of, as I say, something almost as if we were living in Alice in Wonderland or Alice Through the Looking Glass, in which the norms of society, the norms of finance, the norms of business are all upended. And as I point out in my conclusion, if you look at Carroll, if you read Lewis Carroll, it's all about time being stood still, or time being put into reverse, or valuations being turned upside down. So it's as if the looking glass world of Lewis Carroll was one that we engineered for ourselves. And I found that obviously intellectually immensely interesting, but look from a perspective of what this augured for our world. I mean, leaving aside the markets, or leaving aside the economy, but what it augured for our civilization was to me at the time profoundly disturbing. And I suppose, again, going back to, as we were discussing earlier, the sense of outrage, in a way, it's the sort of outrage, perhaps, of of the Cassandra who can see, who thinks they can see the direction in we're heading, and which others appear oblivious.
Let me ask you a tough question. Is there a case that says that things have gotten so absurd that a continuation of the absurdity is in order? In other words, like, I know where you would be in economic matters if we were starting from scratch, but given that we're not starting from scratch and we're starting from this very strange place, is there a case for just continuing the craziness?
No, I don't think so. There's an English nursery rhyme that we all used to learn as children. I don't think the Americans have it. And it goes, I knew an old lady who swallowed a fly. I don't know why she swallowed a fly. Perhaps she'll die. And then the next line is that she swallows a spider to catch the fly. And she goes, and then she swallows a bird to catch the spider. And it carries on. And then it says, then she swallows a goat. And then she swallows a horse to catch the goat. And it ends, she's dead, of course. So the point is that each time you double down, you might alleviate your short-term symptoms, but the underlying problems deteriorate. And now I know there is no, I mean, clearly we live in a world not just of to my mind, wrong models, wrong ways of thinking, but also there seems to be a sort of widespread myopia or short-termedness in policymaking, providing, and that might be, again, a sort of slightly civilizational problem, let's say. But one needs to think of the long run, regardless of what Keynes says. In the end, we're not all dead in the long run. In the long run, it catches up with you, which is why one needs to keep an eye on the long run. So I actually think things wouldn't have changed. We would have stayed in this in the world that we've been in, but for the return of inflation. Because the return of inflation changes everything. With the return of inflation, this turning on the monetary spigots to deal with your problem is no longer an option. You have to start turning off the monetary spigots, and you have to start raising rates, and that's what's been happening this year. And that really, I mean, one gets, one doesn't, things don't always appear as one thinks they're going to appear. But it seems to me, whether they like it or not, we've sort of reached the end game. And so, the next years will be, whether we like it or not, the resolution of the types of imbalances and problems that have built up, which I've tried to describe in the book.
I love it. Last question. What are you going to speak about at the Grants Conference in October?
Ooh, I haven't thought about that. I better get on to Jim and hear what he wants me to talk about. But probably, I suppose, something about what we've been speaking about already. But Jim likes actionable ideas, so perhaps I better be a bit more actionable.
Maybe you and Jim on stage together. That would be quite interesting. Well, thanks so much for this time. I'm deeply appreciative.
Thank you very much. It's been a pleasure to be with you.
Rainmakers was gracious enough to be the first sponsor of this podcast. For those of you interested in playing on Rainmakers, download the DraftKings Daily Fantasy app, sign up with the promo code ADAMS, click the Rainmakers tile, and opt in to get your first card free. You will then join thousands of players who are playing for millions in prizes all football season while building the ultimate NFT fantasy franchise with Rainmakers Football. That's promo code ADAMS. Build, play, and win only at DraftKings. Contest entries dependent on type and number of NFTs held. Eligibility restrictions apply. Void where prohibited. See DraftKings.com for details.